Whether you're looking to own a home, buy a car, send the kids to college, or retire someday, building your savings is one of the surest strategies to get there. There are different kinds of accounts you can use to save your money. The most common is a savings account. These accounts don't earn much interest but are a safe place to keep your money as you make everyday transactions. Money markets are like savings accounts with a higher rate of return but less access to your money. You can typically make a limited number of transactions each month. Certificates of deposit, or CDs, differ by having a fixed term. You can't withdraw your money until the end of the term unless you pay a penalty, but CDs usually have the highest interest rates available. It's important to balance growth and access to your money. Leaving a large amount of money in your savings account means that you're not earning as much as you could be if you moved it to a money market or CD. Look for savings accounts, money markets, and CDs that are insured against losses by FDIC or NCUA, which protects up to $250,000 of your deposits. Investment accounts for mutual funds and stocks are not the same as savings accounts, as they involve a much higher level of risk and are not insured. Your first savings goal should be an emergency fund that can cover 3 to 6 months of living expenses. Create a separate emergency savings account and set up an automatic transfer to that account every time you get paid. Start with whatever amount you can, even $5 or $10 per paycheck, but make this a consistent priority so you can get in the habit of saving. After you've built up your emergency savings, you can start on other financial goals. Besides saving up for specific purchases like a home or a car, you can also plan ahead for home repairs. A good estimate is to set aside 1% of your home's value each year. That money can be used for routine maintenance like a furnace tune-up, as well as emergency repairs like a broken sink. To prioritize your savings, try paying yourself first from each paycheck by putting aside your savings before paying bills and covering day-to-day expenses. This can help change your spending behaviors if you're coming up short on your savings goals each month. You could also divide your income based on the 50-30-20 rule: 50% for needs, 30% for wants, and 20% for savings and charity. Another way to build your savings is through a money challenge. For instance, you can save $1 on the first day of the month, $2 on the second day, and so on. After 30 days, you'll have set aside nearly $500. If you don't have a detailed spending plan or budget, create one to give yourself more control over your money. Once you know what your expenses are, you can add your savings goals and adjust your spending as necessary to meet them. To get help with savings plans and other financial topics, check out our other videos or contact Veridian Credit Union today.